So I recently decided just on a whim that I would buy $20,000 of silver at all-time highs. And I'm doing this because I want people to see the power of options. And yes, silver may go up 30 or 40% in 2026. Maybe it'll go up another 100%. Maybe it'll go down 50%. Who knows? But the point is, when you invest, you should always protect your downside. And options are the absolute best way to do that. So let's dive into the trade. Okay, let's dive into the trade. I am in my Schwab account and the market is open. I bought 200 shares of SLV. This is the silver ETF. I'm obviously choosing to get exposure to silver through this ETF because it's highly liquid and I can use options to protect my downside in case silver crashes. So I did two types of trades. The first trade is called a long covered call. On the first batch of shares, I bought 100 shares for about $100 a share. And then I agreed to sell the shares for $5 less than what I paid for. And you can see that right here. Up until January 15th, 2027, I agreed to sell them for $95 a share. This means that if they are in fact trading above $95 a share, I have to sell them for $95 a share. However, I received immediately, let's just keep numbers round and easy. I immediately received $27 per share to agree to this. That goes right into my account. That's called a premium. That money is mine now and forever. But I have to wait this year to see what happens. So if SLV is trading above $95 a share, I have to sell them for $95 a share. So to calculate the profit on this, you simply add the per share premium you collect, which we'll say is $27 per share, to the $95 strike price. That's essentially like what I'll be selling the shares for. And then you subtract the price you paid for the shares, and I paid $100 for the shares. So that's $22 per share in profit. That is about a 22% annualized return. Now, why did I choose to do a batch with this particular option? I did it because SLV has been on a tear and I can still make my money if SLV goes down a little bit or trades tight. I can still get my 22% annualized. And this has some pretty good downside protection. I'm actually protected now to $27 per share if SLV should draw down. So let's just say SLV has a bad year and goes to, we'll say 73 a share. I will have lost no money because I collected the $27 per share in premium. So this is a trade that has downside risk mitigation. Then I bought another 100 batch of shares. I then bought a protective put at $98 a share up until September 30th, 2026. I paid, we'll say, $19 per share for this. So I paid almost $1,900 to buy this protective put. That's expensive. I don't like how costly that is. And what that means is that, let's just imagine SLV goes to zero tomorrow. Let's just imagine. That means I can sell 100 shares for $98 a share. Well, I bought the shares for $100 per share. And so yes, the stock will drop about $2 and then the protection will kick in. But this is very expensive protection. And so then what I did is I wrote a covered call and I agreed to sell the shares up until January 15th, 2027 for $155 a share. And I got paid, we'll say, $14 per share for that. You can see the premium collected was $1,377. So this covered call pays for some of my put protection. So we're just going to keep the math simple. We're going to say that the put protection cost $19 a share, but the covered call paid me $14 a share. So that's a net $5 in put protection. So my worst case scenario on the trade would be if SLV would go to zero tomorrow, I would lose the cost of the net cost of the put protection. I would lose that. So that'd be $500. But then the shares went from $100, which is my cost basis, to then $98 before the protection kicking in. So my worst case scenario would be $700 should SLV, let's say, go to zero tomorrow. Now, yes, I understand that I'm only paying for protection up until September 30th, 2026, and I did this to cheat a little bit and not pay as much put protection. That's a little more advanced, but don't worry about that for right now. So my worst case is 700. What's my best case? If silver has a great year and goes up and SLV gets to 155 or more, actually, technically, if SLV gets to more than 155, I have to sell that batch of shares for 155. 155. So I simply take the 155, I subtract what I paid for the shares, which was 100. That is a $5,500 profit, 55 per share. And then I subtract the net cost of the put, which was $5. So my profit, my best case scenario, is $50 per share on that batch of shares. And my worst case was $7 per share. So worst case, lose 700, best case, make 5,000. So that trade has great asymmetry. And of course, anything in between can happen. Now, if you're new to options, that might have been a lot, but if you continue to follow my trades, just to learn about options, that's the whole idea. You will then learn over time how these really powerful tools work. So I will be updating you on this trade every few weeks.